And we are officially live. Good morning. Welcome to Money Matters only on onedealaway.com. My name is Nev, and today we have a very, very important show as always. Now, before we get into the show, I do want to put it out there that we do this show each and every day at 7 a.m., broadcasting live straight out of New England in United States. And today's show is going to be very, very interesting and very good, I would say, excellent show. We're actually going to talk about yesterday we kind of finished it, and I sort of left you with a little cliffhanger of showcasing a particular Bloomberg terminal saying, what can you spot that is a knot? Not that it's not supposed to be there, but it's unusual that it's there. And it's something that is incredibly bullish for blockchain. Yes, it's very, very bullish for cryptocurrencies, for blockchain. And we're actually going to go and cover and discover what does this mean. And we're going to talk about it all in depth. And then after that, as we do every single Thursday, we are actually going to go in and talk about real estate because real estate is an incredibly important industry for economics as a whole. And the reason for that is that, well, it sort of drives a lot of things. A lot of wealth is being stored inside real estate. A lot of economic motions and employment pieces are attached to it. And of course, it's very connected component to the economy and what's happening around us as a whole. So I think it's very important to talk about it from that perspective, but then also from the investment perspective. I do believe that real estate is one of the absolutely best industries, asset classes that you can get into to preserve and potentially grow your wealth. And so, because of those beliefs, because of my passions for it, we cover real estate very, very regularly, incredibly regularly, because it is important concept to think about, talk about, and really look at ways of how do I escape this whole piece of Wall Street casino where my money is being gambled with. I don't know what's going on. It's being manipulated left, right, and sideways. And it's really the insiders that make money, not people that are actually funding it. And I don't like those odds. I like the odds of if I fund it, I win it, right? I get the whole thing. And when they talk about gold, they say if it's not your vault, it's not your gold, and I agree. And I think the story of Venezuela and the UK is definitely teaching us that. In the crypto community, say not your keys, not your crypto. Basically talking about that you have to have your own private keys to fully own your crypto, and I agree with it. And for me, if you don't own your physical asset, your real estate, you don't own your money, your wealth. So everything within it is all about owning, which owning means control. And when we talk about things like stocks and bonds and those kinds of things and other derivatives, you don't really own it. You don't really own it. You are sort of like the beneficiary of it, but there's a custodian to it. They own and control the whole 9 yards. You, not so much. So I am a firm believer of owning your own wealth, of your own money. And all of that, really, honestly, if we're being completely honest, starts with basically education. You got to be educated. You got to understand what's going on, what's happening. And so that's what we're going to talk about. First, I want to welcome everybody who is here live on One Deal Away. Good morning and welcome. And I also want to welcome you who are watching on YouTube. I'd like to welcome you as well. Welcome, welcome, welcome. I am excited that you are here. Do me a favor, hit that smash button, do subscribe, hit the bell so you get notified every day that the show goes on. And it does go on every single day. All right, enough chatter. Let's do this. All right. Good morning, good morning, good morning. What is today? Today is Thursday, July 9th. Can you believe it? It's Thursday already. It feels like Monday was just yesterday. So many things going on, and as they say, time flies when you're having fun. And boy, it seems like I'm having a whole lot of fun. Because let me tell you, the older I get, the faster time goes. So clearly, I am enjoying myself way too much. I need to slow down. All right. So this is how we left it yesterday. We talked about the Bloomberg terminal. I said anything different about this Bloomberg terminal. And you might or might not have watched yesterday's episode, which if you haven't, I highly encourage you to do so. But if you have and you haven't paused to take a look, let's go in and take a look. Now, this is a Bloomberg terminal and it's very, very regular. All of the stuff over here, you get to see the name, the industry, what's going on, blah, blah, blah. Nothing much happening except down here where my mouse is. As you can see, it says notes, and you will see something very random. OXB647FA4E. And for those of you that are crypto enthusiasts, you don't even have to go all the way to Ethereum contract to understand that this is a crypto address. So, yes, it is, and it's a cryptocurrency or it's Ethereum contract address, right? And so now it goes, wait a minute. Now, what are we looking at? You're looking at a bond that has been issued to a NASDAQ traded restaurant corporation called Fat Brands, a company that franchises over 400 restaurants. So this is a bond on NASDAQ, but it does have something interested, and that's Ethereum contract. And as you can see, it's basically saying, wait a minute, this is a 40 million corporate bond for public company selling on Ethereum. Yes. And so the question comes in of, is this the beginning of Wall Street replacing its settlement layer with Ethereum? So all kinds of questions, and we're going to jump in exactly to talk about this component right now. Now, what is going on? So they're basically using folks to be able to talk about it, and the author of this particular article is talking about the fact that sometimes you can go on the brokerage institution and you could accidentally place some orders that you don't understand necessarily, and it's very, very hard to because it's not very clear of who owns what, how much, and all of those components. It is possible that you might get into creating something extra that you didn't plan or participate in it. And it's saying that it's hard for the brokerage firms to actually control that. And he's sharing a story of his experience with Fidelity, and is saying that he ended up calling the representative from Fidelity, who said, Fidelity is able to allow people to place a trade without the money as long as they believe that it will be paid by settlement time. So you could actually go get yourself into trouble that even if you don't have money in your account, you can place a trade, and then when that trade is set to expire, you'll be called to basically pony up the cash, which could be very, very scary and very risky. And so, as he was talking about here, he was like, wait a minute, I don't really own the assets in my brokerage. And that is absolutely correct. You don't. When you have money or assets in your brokerage, the brokerage really actually owns it. You just end up being sort of a beneficiary if there's money left over. But most people don't know that. Now, here we go. Let's go in and talk about this particular sort of component and how crypto and blockchain is actually shifting that stuff and how it's improving upon the current challenge, how it's fixing it. The problem of tracking ownership of an asset is a difficult one, not just for brokerages, but there are cap tables, they're off the track and spreadsheets and can get fat fingered, meaning, you're not paying attention and you enter something that you're not supposed to. Lord knows I've done that, especially when I'm trying to use my smartphone and I'm trying to type stuff, fit turns to fat very quickly, so anyways, rehypothecation and short selling can lead to more shares existing than should. shareholders end up owning about 33% more shares than were supposed to exist. This is the problem with some of the derivatives and some of the creation of what you're able to do, because the financial market has expanded quite a bit to be able to do all kinds of crazy stuff that it didn't before. But unfortunately, most of us are not educated about that stuff. We don't talk about that stuff. And so typically when we think about the shares, we're thinking about just that is created. But there's so much more in the derivative world. It's way, way, way bigger. And so that kind of brings back the whole concept of, if we were to talk about gold, for example, you have a physical gold market and you have the spot. In the physical world, there's only so many ounces or tons of gold in the world, right? There's a cap to it, which is what makes gold, one of the reasons that makes gold very attractive asset for people to get into, hold for long term. On the spot market, you can create as much gold as you want because it's paper, it's digital-ish. When I say digital, I mean it's in a computer, but it's not like full-blown crypto. Okay, so let me put the distinction between the digital, because I kind of feel like we have to in today's age, day and age. So you can create all kinds of stuff, and you control, you can control ton of gold with like a few $100. So most people will understand that doesn't make sense, but that's the world of derivatives and leverage trading. So that's kind of what he's talking about over here. Now the share, you probably heard all kinds so he's talking about that there's a challenge because no one global representation of the state ownership at any point at any time. So he's saying that if you've been in crypto, you probably heard of this and know for several companies trying to tackle the problem with blockchain, T0, Securitize, etc. However, there's one company that is already using Ethereum mainnet to solve its problem in the niche finance space of securitized business lending called Cadence. Now, first piece I want to talk about, mainnet is basically where things are live, so to speak. You have a test net where you go in and test, you play around, right? Kind of like a practice piece, sort of like for real estate investors, it's kind of like playing the game of Monopoly, right? With Monopoly money and little tiny green and red houses. And then you jump on the mainnet, which basically means you truly go out there and you buy an actual house and you start playing Monopoly in the real world with real money, with real houses. They're probably not going to be reading red, green and red. They might come in different colors as well. So Cadence is one of the companies that is solving that stuff. And so we're going to talk about Cadence and kind of what they're doing. But before we go there, I figured why not showcase Cadence? And here is Cadence website. And basically what it's saying is that is unlocking access to exclusive high yield short-term investment traditionally reserved for institutions. You can earn up to 10% APY on your investment in as little as 1 month, and your minimum to start is $500, which is actually very, very cool because typically this kind of investing has been reserved for corporate investors, right? Like large investors, institutions, accredited investors. And if you don't know what the accredited investor means, it basically means that you have quite a bit of money. And the government, rightly or wrongly, assumes that because you earn $250,000 a year, that you are intelligent when it comes to money, which may or may not be true, right? We do have people who earn way less who I think understand money way more, but the government is putting some of these rules and regulations in order to protect it. That's sort of one side of looking at it. The other side of looking at it is to say, government is doing this to prevent people who are already not rich to become rich. That too could be a very, very good argument piece. So basically what they do is they give you opportunities to invest in different components. It's secured on the mainnet and on the Ethereum blockchain. It has its own crypto, I believe, and it's an interesting project for sure to take a look at. If you click further, you can actually look at investors, how it works, and past deals. We can definitely look at how it works. and it basically says that it doesn't give you a whole lot of information here when you go into it, which always is interesting to me. I know that some of these websites, when you create them, you want to put it in a very simple terms, so it's really easy to read and understand. But I think they are shortchanging themselves because they're leaving it very vague as to what you invest. So we are not going to spend time over here a whole lot. We're going to jump into this article because it does an excellent job explaining what cadence does, or cadence. Is it cadence? Is that how you say it? All right, it's cadence. Okay. All right. Yeah. Okay. So now we know that before we jump into it, we know that for a very long time we have been living in a low interest environment, right? And we've been talking about, even on Money Matters on this channel in this show, for weeks. We've been talking about the fact that it's hard to find yield. It's hard to find a place where you can put your money and actually make money, right? Way back when in the past, you could actually put your money in a CD or savings account. You get nice 5, 10, 15% interest way back when. That 15% plus interest is before my time, y'all. But we used to see those returns, and you could put it in bonds and get nice 5, 7% return, which wasn't huge, but it was definitely above the pace of inflation. So your money was actually growing. It was doing stuff. Now we have this ridiculously low interest environment for about decade, a little bit more. And now in the past few months, we have hit even lower rates back again. And it looks like it's going to stay that way in unforeseeable future. Well, that becomes a problem because if you put money in a savings account, you get what? A tenth of a percent, if that. If you put it in a CD, you get like maybe 0.25, so a quarter of a percent, maybe half a percent if you're really, really, really lucky and you lock it up for like 5, 10 years. Well, that doesn't make sense. Then you go into the bonds, and bonds are giving you 0.75, 0.8%. Whoop-de-doo, 30 years and you get like that. So that doesn't work. Keeping your money under the mattress, that doesn't work because it's definitely not earning anything anyways. So what are investors forced to do? Well, everybody's forced to start chasing yield. And chasing yield basically says that you are looking for returns that are going to give you higher return on investment than that safer piece of putting money in a savings CD or even bonds. So now you have to go in and you have to go into the stock market, into the equities, and sort of hope and pray that the business owners are going to do the right things and that you as an investor are actually going to get money, and that they're not going to file for bankruptcy, because when they do and they get delisted, guess what? You don't whatever you put in, it's useless, right? So there's a high risk that you could lose stuff, but so you have to play in case in case you actually want to be able to grow your wealth. So that's one option. Then people go into and try to get into the options and the futures, trying to day trade, which is even riskier, way higher risk to be able to make money, especially when you don't know what you're doing. Then we have folks that are actually getting into real estate, and real estate is excellent. I absolutely love it. We're going to spend some time definitely talking about it today, and cover as much as we can in today's show a little bit later. But real estate is illiquid. It's great, it's amazing, and there's a benefits to that illiquidity. But the problem comes in if you need, $1,000 or $5,000 or whatever. Like you can't just like take a brick out of the house and be like, here, have a brick. Give me the stuff that I need. So that's where the problem comes in with real estate, even though it is amazing and it provides much better returns, and not just on appreciation, but if you're an investor and you're actually collecting the income from it by renting it, you could look at potentially anywhere from 12 to 15% on the low end, up to 25 to 30% on the higher end, return on investment year over year, which is an insane return on your money, I would argue. And if you buy it the way that I teach in the academy and in my challenge, your returns are actually going to go through the roof. They're going to be in the X's, not the percentages, meaning the times, not the fractions of it, which is what makes it even more profitable and even more exciting. But many people don't know about it. People don't want to learn about it. Whatever, whatever, whatever. If you're interested to learn about it, onedealaway.com slash academy, and it should take you right there. So, anyways, so that those are the options. Then you can go into the crypto, and you can go in and buy and hodl the assets, which is great. You can actually get much better returns. If you go into the DeFi, you can go in and open up, I call it a glorified savings account with stable coins, where you actually able to stake and farm and do some of those things where you can get really really nice return, and even without farming, which is a much riskier aspect, I would argue, than just putting it into a DeFi, staking it and basically lending it to somebody that needs it, which you do it with the collateral, and next thing you know is you're making 3 to 5% return, quite nice yield. However, there's another option, and that's basically coming with cadence. And so, basically saying that there's a thing called, we used to do peer-to-peer lending, which, has been taken over again by institutions. But on crypto, in the blockchain, it still exists. And that's where I was just talking about the whole stablecoin and lending it and being able to make money on that spread, which is quite lovely. But the rates are falling over there as well, so you're not getting as high of a return anymore when you're just saving on the blockchain either. So there goes that, right? So that's a problem. So what he's talking about, he said, well, he decided to look into the small business financing, small businesses that need short-term cash flow to pay suppliers and payroll, and they usually collateralize their accounts receivable and other assets to access a short-term financing. This provides a fairly good risk to reward for investors. Now, how does that basically work? Well, as a business, cash flow is important. And while you might, do something for somebody, right? Like sell, for example, this mug to somebody, or not just one mug, but multiple mugs to maybe a wholesaler. Typically, they have a net 30 to pay you. So you have 30 days before you get the money. So you have the accounts receivable, which is basically an asset. It's a promise that your wholesaler that basically bought these mugs from you as a producer is going to pay you whatever the amount is that you have agreed on over the course of 30 days. But during that 30 days, you still have your employees. So you have to pay your employees who are actually making these things, right? You have to pay for that factory floor. You have to pay for the sand and clay and whatever else goes into the mug. I don't know how you make one of those. So that's the reason why you need this short-term financing. So you have an ability to take basically this account payable. You basically hypothecate it, so to speak. You put it in, you turn it in as a collateral. You get cash. You pay your employees. You pay your suppliers. You pay the rent on that factory floor or whatever it is, that however you have it set up. And then in 30 days, when your buyer, when your customer actually sends you the money, you then send the loan back, and then you get to keep the rest of it. And then, of course, then you can put some of it into the capital reserves and that kind of stuff. So that's kind of how and why this works. Now, there are a number of companies out there that allow accredited investors to invest in these assets, but they often require a large amount of capital. Now, then he says, well, I stumble onto the Cadence, and they make it easy to invest with as little as $500. They're integrated with Bloomberg's terminals, and their website was intuitive, and they offer competitive returns. Then they use also Ethereum mainnet under the hood. I've invested in 11 deals. Well, I haven't. The article writer has, and the return rates generally range from 9 to 12% APR. Duration of each deal ranges from 1 month to 1 year, but it's typically 3 to 6 months. They're sourced by various loan originators that have specific industry focus. transportation, small to medium sized businesses, medical small business, Mexican small business, even crypto lending. So you get to see kind of how it all works. It gives you sort of the funding of what they need, and it's really kind of like from what I can see, it's almost like a crowdfunding piece. So you have short-term accounts receivable, and you can see that, hey, this is what the deal is. This is the investment, which is $500. Here is the projected what the return would be. Here is how long it is. So it's a 3-month term. And then, of course, like how many days is left open. And clearly this one is closed. And then, you can click on the deals and you can see that this particular company needed $335,000, but you don't have to give all 335,000. You can give as little as 500, all the way up, I would presume, to the full amount if you wanted to, and and then you get basically paid. Now, the reason it's called collateralized and the reason that it's a little bit smaller risk, because every time you have two types of loans. Every time it's non-collateralized, basically there's nothing except for my good name and word. Those are much riskier loans. They, of course, tend to demand much higher interest as well. But if they don't pay, now you got to chase me. You got to go to court. You got to hope and pray that there's something going on behind that you can then collect. On the other hand, when you have collateralized loan, it basically means that you have some sort of asset that one can sell or benefit from. So an asset can be a car. So when you get a car loan, that's collateralized loan. When you get a mortgage, that's collateralized loan, and probably one of the safest ones, if you ask me, because if you don't pay, then the mortgager, right, the bank, repossesses your home, and oftentimes they can actually make more money than what you owe. So it makes it a very low risk investment deal for them. Similar thing goes with these accounts payable, because typically accounts receivable, not payable, accounts receivable, because typically they're going to be, if it's done correctly, it should be that it's equal or more to the size of the loan. So that's what makes it super less risky. Now, what he's saying is the gradual replacement of underlying structure. Now, why on Ethereum? And it's stated that the founder said that they use Ethereum so that each person's wallet serves as a complete reflection of their transaction activity, and it becomes a perfect audit trail. Each investor gets their own Ethereum address with ERC20 tokens that represent their allocation of these specific investments. They can go to Etherscan and view those tokens. The the term sheet of the deal points to the particular contract on Ethereum representing all owners pseudonymously and their allocations. And this is kind of what it looks like, right? So you kind of see who the issuer is, you see what the security is, what type of stuff, right? So unsecured structured notes, who is the originator, what is the amount, how many notes exist, what is the issue price, net proceeds to the originator, what is the ratings if there is any, what is the trade deal settlement date. So you get to see all of the stuff. When is the maturity kind of happening, period, annualized interest rate, day count, because you want to understand when we're talking about days, are we talking about like on monthly or yearly? So they just need to make sure that they understand how things are calculated, price and maturity. So you get all these different things, including the contract, Ethereum contract address, where you can go in and take a look. SEC registration, so you can see what they're using. So as you can see in this particular one that they're using Regulation D 506B. So, and then of course, who is the distribution platform? And you can see it's with Cadence or with Cadence.io. So that's where you can find information about Cadence in case you're interested. It's with Cadence.io. Now, don't get overexcited. This is not DeFi, decentralized finance, like we know it. This isn't trustless. There's still an intermediary with Cadence. These mainnet contracts serve more as a parallel structure that keeps track of the global state of ownership at any point in time. However, Ethereum automates the backend for them. So they're basically saying that nobody else is kind of controlling the stuff. Ethereum is going to roll out the smart contract, go kind of how things look out, but it's not decentralized completely because you still have Cadence as the intermediary, and they still have an ability to create a new contract, to create additional components within this stuff. So it's not completely decentralized, but it does provide a different way to think through some of the complex issues and challenges that are happening on Wall Street. And when it comes to bigger deals, like the one they just completed on the whole business securitization of Fat Brands, which is the Bloomberg terminal that we saw at the beginning of the show, institutions expect that these securities will be tradable. So here is what the founder of Cadence said. We actually have a path towards the securitization of an asset that people actually want to trade versus others who are just tokenizing things that people have no interest in liquidity for. So when a trustee needs to make a distribution, when a bank wants to make a secondary market, the tokens will have a much bigger role to play to know who owns what and when. So that basically means that if the bank has a lot of the things and they sort of say, well, we want to kind of, get in and sort of double dip, which banks love double dipping. They are able to create a secondary market, and then if it's tokenized, then now the tokens can actually say, well, originally it was assigned to Bank of America, but now there's like 200 additional people that kind of have the portion of this stuff. So that's basically what that ends up happening. So that means that investors will be able to trade ERC20 tokens on mainnet that represent loan contracts and therefore cash flows. So if Bank of America went into the deal that we just looked over here, let's go back and take a look. So let's say over here, Bank of America. So if we know that say one ERC token equals 500 investment, just for sake of argument here. I don't know exactly how it works as far as the exchange. So if Bank of America said, well, we're going to put 5,000, right? So that's 10 times. So they have 10 tokens. And then Bank of America can say, well, I'm going to send it to my investors, and everybody gets a 500. They each get one token from it, and then they can trade it, which represents the cash flow that they're getting from this company. So that's kind of what the goal is over here, what they're trying to look. Securities on Ethereum today, and virtually nobody is talking about it, except they're talking about it in this article, and we're talking about it here only on Money Matters, only on onedealaway.com. Not every business needs to be a DeFi business, and I agree. A lot of them will, but not everybody will, and it doesn't have to be. They are basically having all they are looking is that they have a global ledger that is transparent and open and will give them a strategic advantage over their competition. It's a long game we're playing. This is again coming from the owners and the founders. It's a long game we're playing. We just got the trustee comfortable with the fact that we're even issuing a digital security to begin with. As long as we can prove we can make their lives easier and they make more margin, the chance of adoption is higher. And that's with every business. As long as you're creating business and you're in the business to actually be able to create uh, something simpler for your user, create bigger margin, allow folks to make more money faster, cheaper, right, easier, instead of having to make phone calls and go visit the stuff. It's a click of a button and swipe here and swipe there. It makes it so much easier. So as long as you can do that, you will actually definitely have business and the adoption will go higher. I believe this is how we will see the traditional financial infrastructure move to Ethereum. It will be in pockets, and those pockets will connect and work seamlessly together, building and reinforcement liquidity on each other and making it easier and easier to transact, audit, trade, and invest. And I absolutely agree. So this is one of those things that I think it's very exciting when I look at it and when I consider of where we are and kind of what's what the future is going to be of banking, of finance. I think more of these things are going to start popping up on Ethereum, on blockchain, and is going to be much more transparent, much easier to deal with. Auditing is going to be easier, tracking is going to be easier, ability to split it is going to be easier. So there's going to be a lot of benefits coming our way, and they're already here. But what I'm saying is that it's going to get even more adopted as more people start coming in. Sooner or later, everything, literally everything, will be on blockchain. It's just a matter of time. And when I talk about everything, I am also talking about real estate. Real estate is going to get on the blockchain, absolutely 100%. It might not happen today, it might not happen tomorrow, but it will happen over the upcoming years. So it's definitely coming our way. And that's the reason why we talk about all of those things on here on the channel. Now, I did promise that we're going to go into the real estate, but I'm also looking at the time, and we're slowly but surely running out of it. So we are going to cover a portion of it, and then I promise, you have my word, tomorrow we're going to take a deep dive into real estate. But for right now, I'm just going to leave you with a couple of things to nibble on, think about, consider, come back with the answers. I know I sound like a teacher, don't I? I love teaching, y'all. I love teaching. It's my passion. I would argue that I'm pretty darn good at it, but I don't know. You let me know in the chat. Let me know in the comments of what you think, and also let me know how you feel about Cadence and this whole solution and things being on the Bloomberg terminal, because I thought it was really really cool and really exciting of sort of what the future is. So, quick thing about mortgage, because real estate and mortgage are connected. So, let's talk about it. Rates on 30-year mortgage have sunk deeper below 3%. The average for a 30-year fixed rate mortgage is just has gone down to just 2.92. It's been flirting with 2.94 for days. It's 2.92. I personally expected that it will get even lower, but we will see. We will see. I could be wrong. And the reason that I expect it to go lower has to do with the news and the articles that we're going to be covering tomorrow in more depth. The new record of this kind is surprising because recent news about the economy has seemed encouraging. However, uh, it's not. It's not. The number of unemployed is still not shrinking at the fast pace as it should. The problems and challenges with the forbearance, the unemployment insurance payment piece is coming our way. The eviction piece is coming our way. There's a lot of problems coming our way, and things are not looking better. They're actually looking uglier. So the time to sell is now, now, now. And time to buy is at some point in future. And like I said and promised, we are going to have a deep discussion tomorrow about why that is. We're going to talk about what's going on with U.S. home prices, what can we expect is going to happen over the next 12 months. We're going to be talking about some of the larger cities and how they're impacted and what's going on in those cities and how it has an impact on you, how you should think about investing and all of that stuff. So you do need to absolutely show up tomorrow for another episode. I'm just going to leave you with that. And until tomorrow, until next time, as I always say, stay forever money blessed. And do remember, you are only one deal away.